Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is my good friend Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, welcome back, sir.
Thank you, Ivan. It's good to be back.
Yeah, it's always great having you on. I just wanted to get you on and talk to you about what's happening in the world right now, the craziness that's happening in the markets. You see, a lot of people are talking about why there's so much of a difference between gold and silver. Gold is holding strong and silver is not. Why do you think so, Mike?
Silver's going more the direction of industrial metals. It's more of industrial metals now. It's been demonetized for centuries and it's accelerating. But here's what's in common. Just as we were clicking in to do this recording, I double checked the total change in gold ETF holdings and silver ETF holdings over the past year. They're both down about 10%. Never happened. And both gold's up about 12% and silver's up about 9%.
Right.
So it's never happened. And since gold ETFs really started trading 20 years ago, 2004. So what's going on? And I see I'm more worried that silver is going to continue to track lower with industrial metals and crude oil. I'm bearish on both, particularly because I'm bearish on China. Now that's just think of how that pendulum has swung completely last year, where we were supposed to China reopening is supposed to come out of it, and it's all tilting towards, they have to completely depend on fiscal and monetary stimulus. But I have to point out facts, and there's significant outflows in these ETFs, and there's significant inflows in the intangible new digital gold, and that's Bitcoin. And
Right.
how much of that is one for the other, but you have to point out the facts. And the thing I've been saying for years is you can't hold gold anymore without Bitcoin in that space. And it's just, we're in one of those spaces right now is, if you see what's happening with, US debt to GDP and things like that, if it wasn't for Bitcoin, which it unfortunately shouldn't, I don't like to use hypotheticals, but it's just showing how the world is going to intangible assets, and this new digital gold is just sucking flows.
Yeah. And you see, like a lot of people have been saying this week too. I had a couple of people on Wall Street Silver, and they're saying the reason why gold is holding up stronger than silver is central banks are also buying like a
Yeah.
lot of gold right now. Do you agree with that?
Oh, sure. Well, that's a fact.
Yeah.
The latest World Gold Council report was they used the word colossal for the last 2 years. China's number one, and so look at what's happening in the macroeconomic world. We have this significant tilt where China, with respect for China and its history and its people and its future, one leader has tilted toward the bad guys of the world
Right.
with unlimited friendship. He's tilted toward Iran, North Korea, and Russia.
Right.
One leader. And I think most Chinese citizens like, I think history is going to look back at that and say, to use the American vernacular, dude, what were you thinking? And that's what's happening. It's factual, and the rest of the world who used to import from China, the number one importer in this country is Walmart, has to get out in any way they can. And you're seeing those reverberations. But China is also tilting, and the old bad guys are tilting towards the old guard of gold. I mean, they're the biggest. People's Bank of China is the biggest buyer on the planet at a colossal pace, and they have the ability to print fiat currency and buy gold with it, and they're doing it. So to me, that's the significant. And these wars. I mean, so the key thing, I just published my metals outlook. I think the key thing that's a risk for gold right now is some detente in the unlimited friendship. Say Mr. Z were to be deposed or to pull back and say, it's kind of a mistake. It's not working out. Sorry, Vlad, but pick up on the phone, I can just see the conversation, dude, it's not working. And it's not. So that's one of the key risks for gold. But I think the risk is more the other way. The biggest potential bid for gold is at some point, all these ETF flows will flip to an inflows. And I think that was going to take one key fact and a key flip, I should say. And that is the stalwart U.S. stock market stopped going up. I mean, it's stealing flows, and Bitcoin's just kind of leading the way. And at the same time, you're getting 5% U.S. T-bills. I mean, the safest assets on the planet. That ain't good for gold. And at
Right.
some point, that's going to change. But that's why I'm still bullish gold. But the key thing I like to say is it's kind of hard to be. I think people who are completely biased towards gold and don't have some Bitcoin in that space are taking unnecessary risk with
Right.
advancing technology moving rapidly.
Absolutely. And I was reading some headlines this week, a couple of days ago, and they're basically saying that this AI bubble that we're in is
Yeah.
worse than the dot-com bubble. Like when that bubble does break, do you think it can be a huge contagion and start spreading to other sectors and bring down the whole market as a whole if, let's say, Nvidia just starts collapsing from the all-time highs it's at?
So in terms of how you look at markets, the
Right.
answer is absolutely yes. I think there's a complete inordinate burden. I've never seen it. I've been in business since the 80s, seen it this much of a burden on the S&P 500 to keep advancing. Because if it doesn't, it just drops 5% or maybe 10% in the year, or 8%, or the VIX is at 13%. That means one standard deviation move up or down 13%, at least it used to. That's a severe deflationary dominoes kicking in. And the key indication of that is number one is commodities. You look at industrial metals, most commodities are down about 10% on the year, and only
That's right.
gold is up. So you have severe deflationary forces in commodities. That's a normal high price cure kicking in. And we haven't even started easing except in one key country that's in a major potential reversion, and that's China. Um, and we're on the back of one of the biggest liquidity pumps in history. And it's just a question of how much longer we can keep, and certainly in this country, keep pumping up GDP with excessive amounts of fiscal of deficit spending. So I view that as absolutely the S&P 500 absolutely has to go up. We're going to see severe deflationary forces, which is why I'm very cautious in that space. Which is why
Right.
I think there's many alternatives, and that's why I look at gold and Bitcoin well, Bitcoin I'm still kind of a highly risk asset, and U.S. Treasury long bonds. Treasuries are just I think very they offer decent alternatives, and they haven't been able to offer that type of yield alternative for about 2 decades.
So I just wanted to let everyone know about our new sponsor, Strategic Wealth Preservation. They are an international precious metals dealer and they are a secured storage provider that have headquarters in the Cayman Islands. The company owns and operates a large Class 3 UL rated vault in the Grand Caymans, and they offer other strategic locations as part of its global storage network. They specialize in the acquisition, secure storage, and liquidation of precious metals for individuals, companies, trusts, and wealth management professionals on behalf of their clients. So if you guys want to check them out, the link is in the description below. And another topic too, which has been coming up online recently, Mike, is the banks. They're holding so many unrealized losses in the form of they invested so much into commercial real estate. The
Yeah.
interest rates are so high right now, and they haven't actually declared their losses. It's unrealized, and if they do, it'll be really bad for these banks. When the bank funding term program is going to be ending right away here in March, I'm certain. What happens when it does end? Do you see any type of banks consolidating next month or the next few months? Like how crazy will that be?
Well, so there's been consolidation in banks, notably in the U.S. for decades, at least
Right.
a decade, and J.P. Morgan's a great black hole. Um, I remember having a good friend at Bear Stearns, and that's now part of J.P. Morgan, but that was another story.
Right.
Um, but the fact is, I like what Jamie Dimon said. The commercial real estate will be fine as long as there's not a recession. But that's where I get that tilt. The stock market absolutely has to go up. I've never seen it this risky in my lifetime. Inverted yield curve, leading
Hmm.
indicators, China in decline. Japan in recession, UK in recession, Germany in recession, most of Europe in recession. The average of PPI, so the US, the top four horsemen of the world, I think I mentioned this last time, US, Japan, Germany, and China is -3%. That's severe deflationary forces from the high beta leading indicator. So
Right.
banks, a contraction in lending, how can you expect not to have economic problems? That's why I view it as what that to me is where that's showing up is a contraction in lending. You see diesel demand in this country is the same as 2017. We have not had that long period of stagnation ever in our database back to the 90s. Unleaded gas demand is declining. Paperboard box demand is declining. All various recessionary trajectories. And the key thing, the only thing that's keeping us going here is there's some of the data still strong as obviously is the stock market. And that should be the leading leading indicator. That's why I look at it. It is so risky. And then I look at S&P 500 minis. There's a gap down almost 10% below from December when we had that manic rally. So I look at this as it's been so we're recording on February 27th. It's been a great year for stocks already. The total return for S&P 500 is almost 7%. That's getting a little speculative excess. And here's the key thing I want to end with, Ivan. One thing that's really hit me lately is the high price cure is kicking in stock market. So it was one of the key things I started pointing out in commodities about 2 years ago. It's something you learn from a farm background, which I have, used to own a farm, is farmers always say it. And commodities are in the middle of the high price cure, the
Right.
back end of that scale right now. The prices went up too much, so technology kicks in, supply and demand kicks in, and prices go down. They're still heading lower, with the exception of one, which I think is heading towards a low price cure now, and that's natural gas. But now the stock market's in that phase. There is no reason with the S&P 500 and massive speculation in the stock markets and in cryptos this year going up that much, and the Fed's inflation targets, core PCE, core CPI above their targets to ease. And every time the stock market goes up, you see those easing expectations taking out. And most people will tell you the number one thing for equities is liquidity
Right.
and easing. And so that to me is the problem, that the more it advances, the more there's easing comes out of the market, which means it's the high price cure might kick in equities. And I've been early. I've been wrong. If I was a trader, I would have been stopped out, admitted. Um, and it's maybe why I used to have hair and I don't trade anymore. But as a strategist, you have to point out these facts. So that to
Right.
me is where the macro big picture is coming in. And I just look like this speculative frenzy that's kicking in Bitcoin now. It's just a sign that there is no reason at all for central bank easing in this country until you see those speculative exits wrung out of the market. Because here's a key thing I'll end with. The book
Right.
I read recently was called Capitalism Without Capital. I think McGregor was the author. I don't remember, but all about the difference, the significant difference in intangible assets versus tangible assets. Commodity and gold are tangible assets, but
Right.
they're really falling by the wayside by intangible assets. And intangible assets, as measured by S&P 500, are rising rapidly. So expect inflation to decline in that environment is very unlikely, i.e., the
Right.
wealth effect. And Bitcoin's an intangible asset. Gold is a tangible asset. So there's where you have a little bit of a battle.
Yeah, you absolutely nailed it, Mike. And what a breath of fresh air having you come on to Wall Street Silver. Like huge, like we greatly appreciate you. And where can people contact you?
I'm on Twitter at Mike McGlone 11 and LinkedIn, Mike McGlone, Senior Commodity Strategist at Bloomberg. And if people want to shoot me a message and get on my distribution list, I'm happy to add them. I think I've added you. Have I added
Yeah,
you to
yeah,
my
yeah. I think
distribution?
I
Yeah,
think
good.
I make sure I added you, and I'll put your all your links in the description below so everyone can contact you.
Well, thanks for having me. I mean, I always
Yeah.
appreciate our conversations. I'm looking forward to the next one and see how the world has changed.
Yeah, I'm sure in the next couple of months it's going to be crazy. So I'd love to have you back on.
Yeah, we had this little elections getting entertaining, and one thing I like to point out is what's going on in China is epic, historic, and I lived through it, being working for Japanese firms 30 years ago, and I think this is worse.
Oh, okay.
So the, the
That's
reversion the reversion process happening in China.
okay, awesome. Well, again, it's a huge pleasure and would love to have you back on within the month or so, Mike.
Okay, thank you.
Take care.